Welcome to the Deep Dive. Today, we're taking you on a trip behind the scenes of the stock market
Yeah.
to explore this world of, technical indicators, I guess. Think of them as those secret signals that traders use to try
Right.
and predict the market's next move.
Yeah. It's like learning a whole new language.
Right.
One that can speak volumes about the past and give us some hints
Right.
about, what the future might hold for stocks.
Yeah, you sent us some articles about these trading indicators.
Yeah.
And honestly, it's fascinating stuff. I'm already feeling like we're cracking a code here.
Yeah.
Are you ready to become fluent in market speak?
Let's decode this together.
All right, so first things first.
Sure.
What exactly are trading indicators?
Hmm.
I keep imagining something like, a car dashboard
Yeah.
with all these gauges telling us how the market is running.
That's a great analogy.
Okay.
Indicators are like gauges, taking historical data like price, volume, even open interest, and then using formulas to give traders insights to possible trends and patterns?
So it's not a guaranteed crystal ball for picking winning stocks.
Not quite. It's not about knowing the future for certain. It's more about recognizing patterns from the past and using those to make smarter trading decisions.
Got it. So no crystal ball, but definitely a powerful tool.
Yeah.
But why would I care about these signals? I'm not, a day trader glued to my screen watching every little price change.
That's a fair point.
Right. Yeah.
But whether you're a day trader or someone investing for the long haul, understanding how the market is trending can be incredibly valuable.
Okay.
Indicators can cut through the noise and highlight patterns you might not see just by looking at price charts.
Yeah.
They can give you a better sense of when to buy, when to sell,
Right.
or even when it's best to just sit tight and wait.
So it's like having a friend who's really good at reading the room at a party.
Exactly. They provide that extra layer of insight
Right.
to help you navigate the market more effectively.
Okay, I'm starting to see the value here.
Good.
But there are so many different indicators out there.
Yeah.
Like a whole new language to learn. Where do we even begin?
You're right. There are many types of indicators,
Right.
each designed to reveal different things about market behavior.
Okay.
But don't worry, we'll break it down into manageable categories.
Right.
Think of it as learning the grammar rules of the market,
Oh,
one step at a time.
Perfect. Let's start with the basics.
Sure.
What's the first category of indicators we need to understand?
First up, we have trend indicators.
Right.
These are the ones that show you the general direction of price movement. Think of them as a compass for the market,
Okay.
telling you if things are headed north, south, east, or west.
So if a trend indicator is pointing north,
Yeah,
it means prices are generally going up.
exactly. A great example of this is the moving average. It smooths out price data over a specific period, giving you a clearer picture of the underlying trend.
Okay.
It's a simple but powerful tool, kind of like following a breadcrumb trail.
Okay, trend indicators. Check this next.
Next, we have momentum indicators.
Okay.
These focus on the strength or speed of a price movement.
Hmm.
Is the market casually strolling along, or is it sprinting,
Right.
like it's late for a meeting?
Ooh, I like that. It's like feeling the energy of the market.
Yeah.
Is this stock ready to take off, or is it about to hit the brakes?
Exactly. One popular momentum indicator is the Relative Strength Index, or RSI.
Okay.
Picture a meter that goes from ice cold to red hot,
Okay.
indicating whether a stock is overbought or oversold.
So if the RSI is flashing red hot,
Yeah.
it might be time to take some profits off the table.
That's one way to interpret it.
Okay.
It could be a sign that the market is getting a bit ahead of itself, and a correction might be around the corner.
Trend and momentum. Got it.
Yeah.
What other signals are we looking for?
Now let's talk about volatility indicators.
Okay.
These measure the rate and intensity of price swings.
Okay.
Think of it as the difference between a leisurely Ferris wheel ride
All right.
and a heart-stopping roller coaster.
Yeah.
Volatility tells you how wild the ride might get.
Okay. I'm feeling a bit queasy just thinking about those market roller coasters.
Yeah.
So how do we track this wild ride?
One popular tool is Bollinger Bands.
Okay.
Picture these as bands that widen and narrow around the price of a stock.
Sure.
When the bands are wide, it means volatility is high,
Okay.
and things are getting a bit crazy.
Right.
When they narrow, it suggests a calmer market environment.
So wide bands equal buckle up,
Right.
and narrow bands mean we can relax and enjoy the ride.
Precisely.
Okay.
Volatility can be a bit scary,
Yeah.
but it also creates opportunity.
Right.
Traders use these bands to try and anticipate big price swings.
Interesting. I'm starting to see how all these pieces fit together. What's the last category we need to cover?
Last but not least, we have volume indicators.
Yeah.
These focus on the amount of trading activity, which can be just as important as price itself.
Okay.
It's not just about what price is doing, but how many people are actually buying or selling.
Right.
Think of it as the buzz or chatter around a stock.
So we're listening to the market gossip, trying to figure out what all the whispers are about.
Exactly. A well-known volume indicator is called on-balance volume, or OBV.
Okay.
It tracks buying and selling pressure to confirm trends.
Okay.
If volume is increasing along with price, it adds conviction to the move. If volume is declining, it could be a warning sign that the trend is losing steam.
Okay, so we've got our trend compass, our momentum speedometer,
Yeah.
our volatility roller coaster, and our volume gossip hotline.
Right.
It's a lot of information to process.
It is.
I'm starting to feel like a market detective.
It can feel overwhelming at first, but remember, these are just tools. The key is to understand what each indicator is telling you and how to use them effectively as part of your overall trading strategy. It's like learning to read the signs and signals of the market.
So knowing the signals is only half the battle.
Exactly. Indicators are not magic bullets. You need to develop a sound trading plan, manage your risk, and practice your skills. It's like learning to play an instrument. You can know all the notes, but it takes practice and skill to make beautiful music.
Okay, we've laid the groundwork here.
Yeah.
We know what indicators are, why they matter,
Right.
and the different categories.
Yeah.
Now let's get to the million-dollar question.
Sure.
How do traders actually use these things in the real world? Do they have a secret encoder ring or something?
Well, that's where things get really interesting.
Okay.
Most traders don't rely on just one indicator in isolation. They combine multiple indicators to get a more complete picture of the market. Kind of like cross-referencing clues in a detective novel to solve a case.
I love that analogy.
Yeah.
So it's not about finding the one perfect indicator. But about piecing together different signals.
Yeah.
To build a compelling case for a trade.
Precisely.
Okay.
Let's say you're looking at a stock chart. You might use a moving average to identify an uptrend.
Okay.
And then use the RSI to confirm that the market isn't overbought. Suggesting there's still room for the price to keep climbing.
So it's like having a two-step verification for our trading decisions.
Exactly. By combining indicators, you can increase your confidence in your analysis and potentially filter out false signals. Those red herrings of the market.
This is fascinating stuff, but I have to admit, I'm still a bit intimidated by all these charts and numbers. Any tips for someone who's just starting out with technical analysis? Should I start carrying around a market decoder ring?
No need for a decoder ring.
Okay.
The best advice is to start slow and focus on learning one indicator at a time. There are tons of resources available online, including educational materials from reputable brokerage firms.
So don't try to become a market wizard overnight.
Not at all.
Okay.
Just like learning any new skill.
Right.
It takes time and patience. You'll get there.
All right. I'm feeling a bit more confident now.
Good.
We've covered a lot of ground here.
Yeah.
But before we wrap up this part of our deep dive, I have to ask, are there any risks or limitations to using these technical indicators?
That's a great question.
Yeah.
While indicators can be powerful tools, they do have their limitations.
Okay.
Remember, they're based on historical data. Which means they're not always perfect predictors of future price movements.
So just like those warnings we always hear.
Yeah.
Past performance is not necessarily indicative of future results.
Exactly. The market is constantly evolving, and sometimes those historical patterns break down. That's why it's so important to use indicators in conjunction with other forms of analysis.
Okay.
Like keeping up with current events that could impact the markets. It's like having multiple tools in your toolbox. You wouldn't use a hammer for every job. Yeah.
And even with the right tools, we need to know how to use them correctly.
Absolutely. Another important point to remember is that indicators can be subjective.
Okay.
What one trader sees as a buy signal, another trader might see as a sell signal. It's not an exact science. And there's a degree of interpretation involved.
So experience and skill really come into play when reading these market signals.
Precisely. Over time, you'll develop your own style of reading and interpreting these signals. It's like learning a new language. The more you practice, the more fluent you become.
Okay, so we need to be aware of the limitations and avoid blindly following any one indicator. Any other words of wisdom before we move on to the next part of our deep dive?
One final thought.
Right.
Be mindful of the self-fulfilling prophecy effect. If everyone starts using the same indicators and interpreting them in the same way, it can actually influence market behavior, which can be a bit of a paradox.
So the more popular an indicator becomes, the less effective it might be.
It's definitely something to consider.
Okay.
The market is a complex, adaptive system, constantly reacting to the actions of its participants.
Wow, that's a thought-provoking note to end on.
Yeah.
We've covered a lot of ground in this first part of our deep dive into technical indicators.
We have.
We've learned what they are, the different types, and even how traders use them to make decisions.
Yeah.
But I have a feeling we're just getting started.
You're right. In the next part of our deep dive, we'll take a closer look at some specific examples of popular indicators and how to interpret them. We'll also delve into some of the strategies that traders use to combine these indicators and make more informed trading decisions. It's time to put our detective hats on.
Okay.
And crack the code of the market.
Sounds good. I'm ready to level up my market knowledge.
Great.
See you in part 2.
See you then.
Welcome back to the deep dive.
Hey.
Ready to put on those detective hats and explore some real-world examples of how traders use these technical indicators.
Absolutely. In part 1, we covered the basics, the different types of indicators. Now I'm ready to see these tools in action.
Okay.
Let's crack the code of the market and see how these signals can help us make smarter trading decisions.
All right, let's start with one we've already touched on.
Okay.
The moving average.
Right.
It's a classic indicator for a reason. Remember, it smooths out those price fluctuations.
Helping us see the bigger picture, the underlying trend.
Right, like a trend line on autopilot filtering out the market noise?
Exactly.
Okay.
And there are different types of moving averages. You've got the simple moving average, which gives equal weight to all price data in the period.
Right.
And then the exponential moving average, which puts more emphasis on recent prices.
So the exponential moving average is a bit more reactive, quicker to pick up on those shifts in momentum.
Precisely.
Okay.
Now, here's where it gets really interesting.
Wow.
Traders often use multiple moving averages with different time frames, like a 50-day and a 200-day moving average.
Right.
And the crossover points of these lines can generate powerful signals.
So this is where we get those legendary golden cross and death cross patterns I've heard so much about.
Yeah.
Tell me more.
You got it. Imagine you're watching a stock chart. When the shorter-term moving average, like that 50-day, crosses above the longer-term moving average, the 200-day. Okay.
It's often seen as a bullish signal.
Okay.
That's your golden cross, suggesting the bulls are taking control.
Okay. Golden cross, bulls are in charge.
Yeah.
Got it.
Wow.
And the death cross. That sounds a bit ominous.
Right. Well, if that shorter-term average crosses below the longer-term average, it can signal a bearish trend reversal.
Okay.
That's your death cross, a potential warning sign that the bears might be taking over.
Okay. So we're looking for these crossovers as potential turning points in the market.
Yeah.
That's like watching for those plot twists in our market story.
Right.
What other indicators should we have on our radar?
Let's move on to the Relative Strength Index, or RSI. All about that market momentum. Remember, it measures the magnitude of those recent price changes to see if a stock is overbought or oversold. Our ice cold to red hot meter.
Right. And if it's getting too hot, maybe it's time to cool down a bit, take some profits off the table.
Exactly.
Traditionally, an RSI above 70 is considered overbought, signaling a potential pullback.
Okay.
While an RSI below 30 is considered oversold, hinting at a possible bounce. But remember, these levels can be adjusted depending on the market and the specific asset you're trading. What might be overbought for a high-flying tech stock might be perfectly normal for a steady blue-chip company.
Okay, so we need to consider the context.
Yeah.
It's not just about the numbers themselves, but also about what those numbers mean for that particular stock or market.
Right.
Makes sense. Now, what about those Bollinger Bands we talked about earlier, the ones that help us visualize volatility?
Bollinger Bands are great for understanding those price fluctuations.
Okay.
and identifying potential breakouts.
Right.
Remember, they create those expanding and contracting bands around a moving average. So when the price touches or breaks outside of that upper band, it could be a sign that things are getting a little overheated, a potential overbought situation.
Okay. And on the flip side, a touch or break of that lower band could indicate an oversold condition.
So it's like a breakout alarm,
Yeah.
letting us know when the price is pushing those boundaries.
Exactly.
Okay.
And here's another thing traders look for. Those periods of narrowing bands.
Okay.
Because they often come before periods of increased volatility. It's that calm before the storm.
So those quiet periods on the chart might actually be a sign that things are about to get interesting, maybe even a bit wild.
Exactly. It's all about anticipating those shifts in market dynamics.
Right.
Now, we've talked about moving averages, RSI, Bollinger Bands. Are you ready to add another key indicator to your toolbox?
Absolutely. Bring it on.
Okay.
My market detective skills are getting sharper by the minute.
Okay, let's explore the MACD, which stands for Moving Average Convergence Divergence.
Okay.
It's a momentum indicator that shows the relationship between two moving averages of a stock's price.
Whoa, that sounds a bit complex.
Can we break that down a bit further?
Sure, think of it this way.
Okay.
The MACD line is calculated by subtracting a longer-term exponential moving average, usually 26 periods, from a shorter-term exponential moving average, typically 12 periods. And then there's also a signal line, which is usually a 9-period exponential moving average of that MACD line itself.
Okay, two moving averages and then a signal line based on the MACD.
Right.
I think I'm following so far.
Yeah.
So what are we looking for with this MACD indicator?
We're watching for crossovers between that MACD and the signal line.
Right.
When the MACD crosses above the signal line, it can be a bullish signal, suggesting momentum is picking up to the upside.
Right.
And a crossover below the signal line could be a bearish signal, indicating momentum might be shifting to the downside.
So it's like those moving average crossovers we discussed earlier.
Yeah.
But the MACD is focusing more on momentum, the strength of the trend, rather than just the price direction itself.
Precisely.
Okay.
The MACD can help confirm trend changes and potentially pinpoint those buy and sell opportunities.
Okay, we've covered a lot of ground with these key indicators, moving averages, RSI, Bollinger Bands, and now MACD.
Right.
But the big question is, how do you actually put it all together? Do professional traders have a secret formula for combining all these different signals?
Well, there's no one-size-fits-all approach. Every trader develops their own style and methodology over time.
Right.
But there are some common strategies traders use to make sense of all this data. It's like having different pieces of a puzzle and then figuring out how to fit them together to get a clear picture.
Okay, I love puzzles.
Yeah.
Let's talk about those strategies.
Sure.
What are some of the ways traders actually use these indicators in the real world?
One popular approach is to use indicators for confirmation.
Okay.
Let's say you're analyzing a stock chart and you spot a potential uptrend using a moving average.
Right.
You might then look at the RSI to confirm that momentum is positive. Maybe looking for an RSI reading above 50.
Right.
It's like getting a second opinion before making a big decision.
So we're double checking our work, making sure the signals align before taking action.
Exactly.
Makes sense. Another strategy is to use indicators to identify divergences.
Right.
This is when the price action of a stock and the indicators are telling different stories.
Right.
It's like noticing those subtle clues that something isn't quite right, even if things seem okay on the surface.
Exactly.
Ooh, market mysteries. Give me an example.
Let's say you're watching a stock.
Okay.
And the price is making higher highs looking strong. But then you look at the RSI and it's making lower highs.
Okay.
That's called bearish divergence, and it can be a red flag. It might signal that the upward momentum is weakening and that a reversal could be on the horizon.
Right.
The price might be telling one story, but the RSI is hinting at something else.
So it's like that feeling when you walk into a room and something just feels off even though everyone's smiling, you know?
Exactly.
Yeah.
Divergences can be powerful warning signs that a trend is losing steam and might be ready to change direction.
Confirmation and divergences.
Yeah.
Okay, I'm adding those to my market detective toolkit.
Yeah.
What other strategies should we be aware of?
Many traders use indicators to help them
Okay.
determine their entry and exit points.
Right.
For example, they might use Bollinger Bands to identify those overbought or oversold conditions we talked about as potential entry points for trades.
Okay.
If a stock's price breaks below the lower band, it might be a good time to consider buying, hoping for a bounce.
Right.
Or if it breaks above the upper band,
Right.
it might be time to consider selling, taking some profits off the table.
So you're using the bands to help time those trades.
Yeah.
Trying to catch a wave at just the right moment.
That's a great analogy.
It's all about timing.
Of course.
Right.
Just like with any trading strategy,
Right.
you wouldn't rely on just one indicator. You want to confirm with other indicators and your overall trading plan before making any moves.
Right. No single indicator is a perfect predictor of the future, but they can give us valuable clues.
Exactly.
Right.
Now, there's another crucial aspect of using indicators we need to discuss, risk management.
Okay.
Because no matter how good the signals look,
Right.
there's always the possibility that a trade could go against us.
Yeah, protecting ourselves from those unexpected market turns is super important.
Yeah.
How can indicators help with that?
Well, indicators can help you set those stop-loss orders,
Okay.
which are designed to automatically exit a trade if the price moves against you by a certain amount. It's like setting a safety net, limiting your potential losses if a trade doesn't go as planned.
So it's like setting boundaries for our trades,
Yeah,
knowing when to cut our losses and move on if things aren't working out.
precise. Risk management is absolutely essential for any trader,
Right.
whether you're just starting out or you've been trading for years.
Okay, so confirmation, divergences, entry, and exit points,
Yeah.
and always managing our risk. These are all great strategies.
Yeah.
It's amazing how much insight we can gain from these technical indicators. It's like learning a secret language of the market.
It is. But I know some people are skeptical. They wonder, do these things really work? Or is it all just smoke and mirrors? What are your thoughts on that?
That's a great question. And I have to admit, I've wondered the same thing myself. There's so much information out there, so many different opinions.
Yeah.
What's your take on the effectiveness of technical indicators? Do they live up to the hype? Welcome back to the deep dive.
We've explored, the different types of technical indicators, and we've even learned some strategies for using them. But now I'm curious, how do the pros, those seasoned traders,
Actually use these tools in their daily routines? Do they have some kind of secret playbook?
It's a great question.
Yeah.
It's not just about spotting one single buy or sell signal. It's about seeing the bigger picture, understanding the story the market is telling.
Okay, paint me a picture.
Yeah.
What does that look like in practice? Are they hunched over their computers in dark rooms, surrounded by blinking charts?
Well, maybe some are, but think of it this way. A professional trader is probably looking at multiple screens, not just one. They're monitoring different time frames, various asset classes, and even keeping an eye on economic data. They're piecing together a whole narrative, like solving a financial jigsaw puzzle.
So it's not about finding that one magic indicator, but about weaving together different threads of information to get a complete picture of what's happening in the market.
Exactly. They might start with a broad market outlook, using indicators like moving averages and MCD to gauge the overall trend.
Okay.
Then they might zoom in on specific assets, looking for patterns and signals that align with that macro view.
So it's a top-down approach.
Yeah.
Start with the big picture and then narrow the focus to pinpoint opportunities.
Precisely.
Makes sense.
And here's the thing.
Okay.
They're not just looking at those price charts. They're also considering things like volume, volatility, and even sentiment indicators, which try to gauge the overall mood of the market.
Sentiment indicators. That sounds intriguing.
Yeah.
How do you measure something as elusive as sentiment? Is there a mood ring for the market?
Well, not exactly a mood ring, but there are ways.
Okay.
Some indicators track the ratio of bullish versus bearish news articles. Others analyze social media, all that chatter online to get a sense of whether people are generally optimistic or pessimistic about a particular stock or the market overall.
So it's like taking the pulse of the market.
Exactly. Trying to feel the collective emotions of all those traders out there.
And while you wouldn't base your trading decisions solely on sentiment, it can definitely provide some useful insights, especially when those emotions are running high.
Exactly.
Okay, so we've got our broad market view, our specific asset analysis,
Yeah.
and now we're even adding in sentiment.
Right.
What other advanced techniques are the pros using? Do they have any secret weapons?
Well, one technique they use, often in conjunction with indicators,
Okay.
is backtesting.
Hmm.
It's essentially taking your trading strategy and running it through historical data
Right.
to see how it would have performed in the past. It's like a time machine for your trading plan.
So you can test your strategy and see how it would have handled those market ups and downs, these periods of volatility.
That's the idea. It can help you spot potential flaws in your approach, adjust your parameters,
Right.
and gain confidence in your system before risking real money. It's like practicing your moves before the big game.
Backtesting sounds incredibly valuable, like having a simulator for the market.
Absolutely. And for some traders, it goes even further. They use algorithms, essentially computer programs,
Okay.
to automate their trading strategies. These trading bots can execute trades based on predefined rules,
Okay.
removing some of the emotion from the decision-making process.
Wow, so it's like having a tireless robot working 24/7,
Yeah.
scanning the markets and making those split-second trading decisions based on your instructions.
It can be very powerful,
Yeah.
but it also requires a deep understanding of both the markets and computer programming.
Okay, so we've gone from basic indicators to back testing to even automated trading bots. It's incredible how much technology is involved in trading these days.
Yeah.
But with all this sophistication, I have to ask, can't these systems be manipulated? Is there a way to game the system?
That's a great question. It gets to the heart of one of the biggest challenges in the markets. Okay. The constant arms race between those trying to exploit inefficiencies and those trying to keep the markets fair and transparent.
It sounds like a high-stakes game of cat and mouse.
It is. As more traders use similar strategies, especially those based solely on technical patterns, those patterns can become less effective over time. It's like the market itself is learning and adapting to the language of the indicators.
So the more widely used an indicator becomes, the less predictive power it might have.
That's it.
A fascinating concept.
It is. And it's one of the reasons why professional traders are constantly evolving their strategies, blending technical analysis with fundamental analysis, and even incorporating elements of behavioral finance. It's all about staying one step ahead.
Wow, it's like the market is a living, breathing entity constantly changing and adapting.
It is.
It's no wonder trading could be so challenging.
And that's part of what makes it so fascinating.
Right.
Now, we've covered a lot of ground in this deep dive. From those basic indicators to advanced strategies, and even the challenges of a constantly changing market landscape. What are some key takeaways our listeners should keep in mind?
That's a great question. What are the most important lessons we've learned from this deep dive into technical indicators?
Well, I think the most important thing to remember is that technical indicators are tools. They can be incredibly powerful and insightful when used correctly, but they're not magic bullets. They won't guarantee riches or predict the future with perfect accuracy.
There's no holy grail in trading, just probabilities and informed decisions.
Exactly. It's about developing your own process, combining multiple sources of information, managing your risk, and always being willing to adapt and learn.
It's a continuous journey of learning and discovery, wouldn't you say?
Absolutely. The markets are a constant source of fascination and challenge. And those who are willing to put in the effort to continuously learn and adapt can definitely reap the rewards.
Well said. Thank you so much for guiding us on this incredible journey into the world of technical indicators. I feel like I've learned so much.
It's been my pleasure.
Well, thank you.
Remember, trading is a marathon, not a sprint. Stay curious, keep learning, and never stop exploring the fascinating world of the markets.
And to our listeners, thank you for joining us on the Deep Dive.
Yes, thanks for listening.
We'll see you next time for another deep dive into a new and exciting topic.
See you next time.
Until then, happy trading, everyone.